This is a game changer. I'm your host, Steve Van Metre, and thanks for joining me today. It's much worse than Fed Chair Powell wants to admit, and the market knows it. Let's go to the Wall Street Journal where we picked today's story up. Jerome Powell signals Fed prepared to slow rate rise pace in December. Talk about a major pivot from where we were just a few weeks ago. If you remember, he was very hawkish at the press conference. We said, hey, wait, maybe he won't stay that way. Now we're getting the first indication. Federal Reserve Chair Jerome Powell provided a clear signal that the central bank is on track to raise interest rates by 0.5 percentage point at its next meeting, stepping down from the unprecedented series of 4 75 basis point rate hikes aimed at combating high inflation. Now remember, we talked about this in a recent show, that the Fed chair gets what the Fed chair wants. So here we're now getting a clear signal that he's ready to dial back down, which means in 2 weeks when that next Fed meeting happens, we have a high likelihood that we already know the answer. So there's only one question will remain is, will there be a surprise to the downside, or will he have a change of heart? But for the moment, now we're back to 50. Mr. Powell in a speech Wednesday said that an overheated labor market needed to cool more for the Fed to be confident that inflation would decline toward its 2% goal. And well, let's put that to the challenge, because here we've got the consumer price index in blue on a year-over-year rate of change. And against that, we're going to put the Fed's preferred job opening survey, which is the JOLTS, the job openings and labor market turnover survey, in red. And we're going to try to figure out if there's any evidence to support that view. And we can note that periods of rising job openings do show a correlation, or we'll say a relationship, with consumer price index, except for this 5-year period between 2015 and 2020. So the evidence here is fairly scant. The notion that this is a labor market issue, the problem is that there's just too many openings, and that's going to cause a wage price spiral where employers are going to drive wages higher, and that will lead to even more inflation. It seems like a bit of an excuse to what's really the underlying problem. And we're going to see that perhaps Powell's claim that the labor market is an issue right now isn't going to be an issue a whole lot longer. Because the Fed has raised rates rapidly and it takes time for those moves to influence the economy, something we've said in the past, it would make sense for the officials to slow rate increases, he said at the Brookings Institute event. The time for moderating the pace of rate increases may come as soon as the December meeting. And there you have it, that again, that signal that moderation means anything lower than 75 basis points, because Powell is well aware. He's studied monetary policy. We know that rate increases or periods of monetary tightening hit the economy with somewhere between a 6 to 12 month lag, can be longer. But remember, that 12-month mark hits next March, so we're already in that 6 to 12 month window right now. And as we noted, many officials have signaled they're leaning toward approving a 50 basis point increase at their December 13-14 meeting. And you may recall I said before that, again, the Fed chair gets what the Fed chair wants, but the Fed chair doesn't want to stand alone, because we can already see a recession coming in the data. Regardless of what the market thinks about this, we know recession now is a very high probability case next year. And what this eventually means is Fed Chair Powell will stand in front of Congress, and he will have to explain himself once again when the Fed causes a recession. Now, you don't want to be the lone wolf here, and so he wants to be surrounded by numbers. It makes sense to him to back off, so when Congress grills him, he can say, look, it wasn't just me. The whole committee agreed on this path, and so he doesn't stand alone. And this is a smart move, and there's a reason I said that he will eventually follow the committee, because he doesn't want to be have his neck stuck out by itself, because that means the chopping block. And what is the problem perhaps in the economy we're seeing? Well, we got some evidence of that today as manufacturing in the U.S. contracts for the first time since May of 2020. Remember, post-pandemic. And again, we've got, at least from the lows where the Fed was doing a lot of monetary stimulus. The Institute for Supply Management's gauge of factory activity slid to 49 from 50.2 the prior month. The measure has fallen in 5 of the last 6 months and stands below 50, the threshold separating expansion and contraction for the first time since the pandemic lockdowns. Now, the issue here isn't that we're at a 49, which is very slight contraction over the prior month. The bigger issue here is, well, note, what did it say? It says a measure has fallen in the 5 of the last 6 months. So the trend, that is what this is all about. The trend is slowing, and what that implies is the trend is likely to continue, this being the first notch of contraction, setting up the case where we'll see further contraction in the months to come. The November composite index reading reflects companies preparing for future lower output. Another sign of slowing economic growth as manufacturers say things are slowing. Now, notably, this is a case where we expect the Fed to already either be paused or cutting, and I want to show you this. Now, we don't have the ISM data here in the St. Louis Fed database, but we do have the Philly Fed, so we're going to use the Philly Fed as our proxy here for the ISM data, and I've got that's in blue overlaid by the federal funds rate. Now you'll notice this crudely drawn yellow line, and this is actually the point where you tend to see where we are right now. And what do we notice in history is the Fed is either paused or already cutting rates. So we have a lot of history to show that when the manufacturing sector contracts, this is a wake-up call to the Fed. They already know it. So it isn't a big surprise for Powell to say, hey, we're going to start backing off, because he really should be at a point where he said, hey, you know what? Full stop. Maybe we did go too far, but he doesn't want to admit that, because then it would actually lend that he's got a credibility problem. Of course, we know he's going to have a huge one during the recession. A measure of prices paid for materials used in the production process fell for an 8th straight month. Again, notice the trend. 8th straight month, the ISM report showed. Input prices, again, a proxy for inflation, shrank at the fastest pace since May of 2020, and a welcome sign that goods inflation is easing amid less stress on supply chains. And again, in the largest consuming nation in the country, a decrease in price pressure on goods inflation means overall inflation is slowing, and there's a lot of evidence here to support that. As we now look at the Philly Fed prices paid, again, our proxy for the ISM prices paid, overlaid against the consumer price index, that on a year-over-year rate of change, and we can generally note that the Philly Fed in blue leads the CPI lower here, which is a strong indication of, again, inflation is coming down, and that means the Fed doesn't need to go any further, even though they still are at least talking about headed another 50 and maybe even more. The group's measure of new orders has contracted. Again, a sign demand is going down for the 5th time in 6 months. Again, notice the trend here. New orders contracted for the 5th time in 6 months, while production gauge retreated to 51.5, meaning slight expansion. The weakest readings for both order backlogs and imports in more than 2 years, as also indicated by yes, softer demand. And here we can look at this current new orders from the Philly Fed and say, is there any indication that this will have an impact on the labor market? And the answer is absolutely yes, it will, because as new order demand falls, we see that trending in the blue line. You'll notice the job openings, the JOLT survey, starts to head over and roll over and go down. And this makes perfect sense, because as new order demand goes away, well, you don't need as many people who manufacture those goods, because you don't have any demand for them, and that should send the JOLT data lower. In fact, based on what we're seeing, let's go back to this chart, we should see a steep drop in the JOLTS data in the months to come. Labor management sentiment continued to shift, with a number of panelist companies reducing employment levels. There we go, through hiring freezes, attrition, and now layoffs. In November, layoffs were mentioned in 14% of employment comments, up from 6% in October. Again, validating exactly what we're seeing here in the data, is that the worst is yet to come. The market already has figured this out. Powell appears to be trapped, because he's got to go along with his rhetoric for at least one more month, and needs something in the data to change so he can back off his hiking cycle. Will we get it next week with a CPI? Maybe. The labor market shows only tentative signs of rebalancing, and wage growth remains well above the levels that would be consistent with 2% inflation, as Powell says he wants your wage growth to go down, to slow down, that you're getting too big of raises. Despite some promising developments, we have a long ways to go in restoring price stability. I'll disagree with that because what do we see today? Job cuts rise in November, causing employees to shift focus to career cushioning. And this is a big shift now in terms of Powell's thing that, hey, labor is a problem. Well, labor is not going to be a problem a whole lot longer. The rate of job cuts announcements at U.S. employers in November was more than 5 times greater than a year ago, according to Challenger report. Overall, U.S.-based firms announced 76,835 job cuts in November, led by the technology sector. Again, the services sector. So far this year, tech companies have announced nearly 81,000 cuts and seems to be just beginning. We're looking at layoffs across the board, so these are broad-based. While we have seen an uptick from the historic low layoffs we've been in the last 2 years, we're not seeing huge mass layoff activity, well, at least not yet. So when we talk about the market reaction and how this is a game changer, well, it's multiple fold. It's a game changer in terms of Powell's rhetoric that we're going to continue to have these aggressive rate hikes, and now we're setting up the potential that this could be the last one in December, or it could even be softer than the 50 basis points, depending on the data between now and then. It also means it's super bullish for the market because they love nothing more than when the Fed is wrong. And that's why you're seeing stocks rally here. And of course, you're seeing the long end of the bond curve start to rally because everybody's figured out that Powell's got it wrong and he can't go anywhere because he's trapped. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.